Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. The markets are still volatile. There's a lot going on at the moment and we are expecting the Fed to kind of hike the interest rates by 3/4 of a point again basically soon, and that will definitely have an impact on the markets because we are already expecting this, right? That will be okay, but that might not crash the market. But if they come out and then say, okay, something else or other than what we're expecting for the next hike to be, okay, because inflation is still going up, like I've talked about that in the last video. So you're gonna have to keep an eye on the market in the next few weeks, because what's happened so far is this. So this month, a lot of the companies, especially tech companies, have lost quite a bit of market cap, right? Microsoft is down 15%. Adobe, because of the situation with the new company they're buying and so on, is down 31.5%. Nvidia is down 26%. Broadcom is down 10%. Not bad. AMD is down 21%. I think last time I checked it was $90 per share, right? So there's so many companies that have lost so much value. Even Intel is down 29%. But there's a lot to do. There's a lot going on within that company. Salesforce. Then you look at companies like S&P Global, for example, MasterCard, Visa, okay, Home Depot of all things, right, is down quite a bit. Procter & Gamble is down almost to 8%. I'm waiting for this company to go down at least to $135 per share so I can add more, okay? Even thing is down right now, Colgate. So there's so many companies that are trading really down at the moment. So what we need to do is look at the market again and then figure out what companies we should add, especially if inflation is gonna keep going up and so on. What do we do in these kind of situations? And one of the things I like to do once a while is just to look at Kevin O'Leary's portfolio. This guy, I agree with a lot of the things that he says, right, in terms of investing in stock market. He talks about basically having companies that have a free cash flow, okay? They have to have a free cash flow that they can use for all sorts of things, like paying off their debt, paying as dividends, buying back their own shares, and basically reinvesting in the business. And there's so many other things they can do with that cash. So what he likes to do is companies that pay dividends and companies that have a free cash flow. So what I'm going to do today is I've looked at his portfolio. He's got loads of ETFs, and within the, they combine all the companies in his ETFs, and I picked 10 companies that I think that could possibly be great if you are starting your investment journey right now, or you've already started and you're looking for dividend companies that are quality companies. They might not be undervalued at the moment, but if the company, basically the stock market keeps going down, then you might get that opportunity to add to your portfolio. So that's what we're going to look at today. And then I'm going to do another video because he doesn't only own dividend companies, he owns non-dividend paying companies as well. So I'm going to put another 5 or 10 companies in the next couple of days that from his portfolio as well. So let's have a look what we're looking for. We're looking for the ticker, we're looking for the company, okay? We're looking for the sector, we're looking for the price of the stock, and whether it has an economic moat or not, meaning is the company competitive, okay, has a competitive advantage. We're looking for the dividend yield. We're looking for the 5-year growth rate of that dividend. We're looking at the payout ratio, okay, how much of their net income are they actually spending on that to pay us. We also I made some changes here. So now I'm looking for the consecutive increases, okay, so how many years these companies have increased their dividends. I'm not looking without cutting. I'm looking for increases. And instead of before, we were looking up for companies that have basically paid their dividends without cutting it. But now we're looking for companies that have increased it, okay? And this is where your dividend aristocrats and kings and come in. So that's what that's a small change. And then safety is still the same. So from simply safe dividend, we're looking for the safety. Anything above 61% is all right. Profit margin, obviously. Free cash flow, absolutely. Total return in the last 10 years. This will give us basically an idea of where the company has been. It doesn't tell us where it's going to be, but obviously we can have that projection based on the growth estimates for the next 5 years, and then Morningstar valuation where there's undervalued, overvalued, and then the fair value for that company, right? So that's the plan. So let's get started with the first company, and this company is automatic data processing, and it's in the industrial sector. It's currently trading $233 per share. So in terms of what the company does and so on, that introduction you can look up easily. It's not that big deal. I mean, you can go to Yahoo Finance to find the information about this company, but they do a lot of the paychecks and basically processing data, so you can look at that later on. I'm only going to give you the data for now. Morningstar is actually saying it has a wide economic moat and dividend yield of 1.78, which is nice dividend, to be honest with you. Is heading the right directions, because as you can see here, for last 5 years they've actually increased that dividend 13%, which is really nice. Their payout ratio is below 60%, which is really good, right? 56% is fine. So that means they have a room to increase that dividend if they need to, and they have increased, okay, basically they have increased this dividend for 47 years. Safety now 97%. That means they are absolutely safe. Profit margin, we're looking about 17, almost 18%, and free cash flow $2.5 billion, which is really good. Okay, that will cover the dividend plus more. Total return in the last 10 years, we're looking about 17%, and next 5 years the analysts are expecting 15% growth in terms of earnings, and currently fairly valued, and it's $222 per share. And as you can see right now, it's $233 per share. It's fairly valued. So if you were interested in that company, what I will do is make sure you are 228. Again, do your research and so on. 228 will probably be the price entry point for me, and maybe take another 5% off that to kind of have your margin of safety as usual. Okay, the next company is, then it's no surprise to anybody, is Microsoft. This company is absolutely amazing. It's probably one of my favorite companies out there. Currently trading $242 per share. It has a wide economic moat, $1% dividend yield, 5-year growth rate of 10%. Okay, so they have increased their dividend. Actually, was it yesterday or the day before? I think they've increased it. I can't remember how much, but the last couple of days they've increased that dividend. Okay, in fact, I'll check it in a second. There you have it, 9.7%. okay, which is really good. That's more than you will get. That's closer to inflation, right? Even higher than inflation, which is really nice. This is why I love dividend paying companies. Okay, they take care of inflation side of this. Some of them will increase like 2-3%. It's not going to be inflation, but you'll get the odd companies that will increase. The reason they're increasing is because their payout ratio is only 25%, and then they have increased this dividend 12 years, 99% safety, 36, almost a 37% profit margin, which is really high, and $65 billion of free cash flow. I think after they've basically gone through the acquisition of the Activision Blizzard, then that might decrease, but for now that's absolutely fine. Total return 24%, and the next 5 years they're expecting about 15%, which is really nice. And as you can see here, 31% discounted right now, and $352 per share is the expected fair value from Morningstar. Okay, right now 242, so there's a bit of an upside, 30-something% there. The next company is Accenture. This company is in technology sector, $270 per share. It has a wide economic moat, 1.44% dividend yield, 9% dividend, 5-year growth rate, payout ratio only 36%, and 16 years of increasing that dividend. Safety, we're looking at about 92%, which is very nice. Profit margin 11, $7.4 billion of free cash flow, 17% return in the last 10 years, total returns that is, and the growth estimates for the next 5 years is about 13%. Fairly valued at the moment, $258 per share is where it should be. Right now, slightly higher than that. So if you were interested again, you might take another 5%, 10%, 15%, depending on what your margin of safety is. Then put it in your watch list. Do your research. Once you're happy, don't take my word for it. Do your research, obviously. Broadcom is currently trading $493 per share. It has a narrow economic moat, 3.33% dividend yield, which is absolutely huge. 5-year growth rate of 43. That's probably the biggest in this list. And payout ratio 66%. They have increased this dividend for 11 years. I think that's how long they have been paying, and they've increased every single year. Safety 67%, which is absolutely fine. Profit margin 31%. free cash flow of $15.3 billion, and total return in the last 10 years, we're looking at about 32%, 15% in terms of growth estimates for the next 5 years, and 20% discounted right now. $624 per share is where it should be. Right now, as you can see, it's less than 500. So again, this is one of the companies in my portfolio that I'm currently adding to. So inshallah, I'll let you know what happens with that. Okay, next one is another company that I own in my portfolio. This is Cummins, $212 per share. It has a narrow economic mode. This is one of the companies that makes the power generators. They also have a diesel engines. They're trying to diversify and be a bit more green as well. So they are absolutely brilliant company. Do your research, find out a bit more information if you're interested. Almost a 3% dividend yield, 5-year growth rate of 7%, payout ratio 30%, and they have 16 years increased that dividend for 16 years in a row without basically cutting or anything at all. Okay, increased it every single year for 16 years. Safety, we're looking at about 98%, profit margin of 8.3%, and then $1.23 billion in the bank. Total return right now, we're looking at about 10% in the last 10 years, and the next 5 years, 8% growth in terms of earnings. Fairly valued at the moment, $241 per share. Right now, we're looking at about basically 212. So it is actually undervalued if you think about it. So it's still fairly valued, but heading towards the undervaluation right now if you think about it. Okay, the next company we're looking at is J&J. This is my favorite company in the stock market. Okay, currently trading $164 per share. We'll see what happens after this spin-off. So we'll see how that comes, what happens to the companies after that. But yeah, it has a wide economic mode, 2.74% dividend yield, 5-year growth rate of about 6%, payout ratio 62%, and they have increased that dividend for 59 years and it has a 99% safety. That's the highest you can get in any company, right? Profit margin 19.2% right now, free cash flow of almost $20 billion, and total return in the last 10 years about 11%. Next 5 years, they're expecting about 4% growth, fairly valued at the moment, $164 per share. That's exactly where it is right now. Okay, if I wasn't up so much, I would actually have added a few more shares of this company, and I think is my biggest holdings right now. There we go, 6.88, almost 7%, right? So the next company we're looking at is Procter & Gamble. Again, another company I love and own in my portfolio. $139 per share. It has a wide economic growth, 2.66% dividend yield, 5-year growth rate of 5%, and payout ratio almost 60%. And it has increased that dividend for 66 years in a row. And it also has a 99% safety, 18% profit margin, $13.5 billion in the bank, 9% total return in the last 10 years, and 5.8 expected growth in the next 5 years, which is really nice. And right now it's trading a premium. Again, like I've always said, I would have loved to add more to this company, but it has been going up and then it came back down a little bit. And so I'm looking at maybe if it hits about 135-ish, okay, 135 or even 125, it will be absolutely brilliant. I'll buy more. 126 is the basic expected price. Right now, $137 per share. Right, the next company we are looking at is Home Depot, consumer discretionary company, $274 per share. It has a wide economic mode, 277 is the price, 2.77, in terms of dividend yield, 5-year growth rate of 18%, which is really nice, and then payout ratio only 32%, 13 years of increasing that dividend, safety 87%, which is really nice, profit margin about 11%, and then $10 billion in the back, 10.8 billion. Okay, total return in the last 10 years, we're looking at about 18%, 15%, almost a 16% growth expectation. Earnings are expected to grow about 16% in the next 5 years. Fairly valued at the moment, $267 per share. Right now, 274 where it's at. So it needs to come down a little bit, even for me, because I generally think I want to buy more of these companies. I would love to own at least 20 to 25 shares right now, but obviously I think I got about 12 shares of this company. There we go, only 12 shares, but I would love to add to that company. Next company we're looking at, Hershey, is a company that I do not own in my portfolio. This is the company that sells Oreos. Okay, $222 per share. It has a wide economic mode, 1.86 dividend yield, and 5-year growth rate of 7%, payout ratio 41%. In terms of increases, we're looking at about 12 years of increasing that dividend. Safety 93%, so that means it's absolutely fine to pay to cover that dividend. 16.8% profit margin, 1.66% of $1 billion in the bank right now. Total return 13% in the last 10 years, and 10% expectation is basically to grow the earnings about 10%, and 35% premium right now is really expensive. 165 is where it should be, but right now 222 is where it's at right now. So again, another great company, okay, but it seems a little bit overvalued. And the final company we're looking at is Waste Management. This is the garbage company. I mean, it collects garbage and basically recycles and all that stuff. $169 per share right now. It has a wide economic moat, 1.5% dividend yield, and 7% 5-year growth rate. Payout ratio 46%, and it has increased that dividend for 18 years in a row. 74% safety, profit margin about 11%, 2.27%, 2.27 $1 billion in the bank, and we have in the last 10 years they actually returned about 19%, which is really good for a company that you would think, oh, how is this company grow and whatever. 19%, that's almost as good as, if not better than, some of the tech companies. That's really good. And 15% expectation is the next 5 years to grow the earnings about 15% every single year. By the way, it's not the whole 5 years, it's every single year they're expecting this to grow about 15%, which is really nice. Again, for that reason, this stock is actually trading higher. Okay, and this is the thing about these companies. Okay, and $228 per share is where it is at, where it should be right now is almost 170. Now, every single company here has excellent free cash flow, right? It has actually done really well in terms of total returns the last 10 years. And then when you look at the next 5 years expectations, the lowest is J&J. Majority of them are basically double digits, which is really good. And when you look at the things that they have done in terms of paying you dividends, it's really like no-brainer why he owns these companies, because these are the best companies out there. And when I looked at his portfolio, there was so many great companies that pay dividends. So I have to go through these companies. Although I own some of these companies, I might be a little bit biased, but at the same time, they are quality companies. You can't deny, for example, I don't own Accenture, but it's a quality company, a company that has, a lot of money in the bank, has returned quite a bit of money to shareholders, okay, and right now expected about 13%. Is fairly valued right now. So if you look in the stock market right now and you're thinking, you know what, there's nothing to buy, then just put some of these companies in your watch list. Okay, do your research, obviously find out what the companies do, okay, what they have said in their latest earnings reports. Is there decline coming? Because some of these companies could potentially start declining, because remember, this is just the estimate, and basically estimate based on what the company have said so far and what the analysts expect. That could change just like that, because look what FedEx done. They came out and they changed everything. They said, no, we're not going to be able to do this and this and this, and it tanked to 23%, I think it was. So you have to be careful, because in the markets that we're in right now, but it's a great starting point. So if you're looking for dividend companies, quality companies, have a look at this list, do your research, and then obviously invest if that's something that you want to do. As always, I'm not a financial advisor, but I'm just kind of sharing my idea, some of the things that I'm doing. I own Microsoft, I own basically Broadcom, I own Cummins, for example, J&J, Procter & Gamble, Home Depot. I love to own Waste Management, and obviously Hershey as well. These are two companies that are still on my watch list, but too expensive right now. Unless they drop 40%, I wouldn't be touching them. So we'll see what happens. But anyway, that's what I wanted to share with you guys. Again, just think about the bigger picture. Like I said in the last video, just think about the bigger picture. None of these things, right now we're up about what, 6% of the overall portfolio. At one point, I keep saying this to you guys, we were in the red. We were in the red 17th of June. We were down £440. And then we went up as far as much as almost 8,000 up. And then right now we're down again. So the market is really volatile. So just dollar cost average every single week, every single month, whatever you will need to do, and make sure you have your your watch list and so on. So I will be sharing with you another video in the next couple of days of the non-dividend paying stocks that this gentleman owns, and I'll let you know how that goes, inshallah. Assalamu Alaikum. Take care, everybody.